All right. What is up? And welcome back, everyone, to another episode of the Long Game Podcast. I almost said the wrong podcast because I also do the Practical Planner. But
can we get professional, please?
Seriously. But I'm excited for this episode. So we have on Zach Ashburn today. And like I say on most of these episodes, if you follow me on Twitter, you definitely see Zach. He's another financial advisor, super good financial advisor, great guy. We've had him on before, but it's been a while. And today we're going to talk a little bit about exactly what he specializes in and honestly what a lot of my clients' lives look like as well. So we're really going to dive into kind of this idea of going from corporate to independence and starting your own company. And Zach, I'm sure you can attest to this, but like this is the golden age of doing that, right? Like it went from people didn't really start businesses, and if you did, it was kind of big businesses, to today we live in this outsourced world where you have your outsourced CFO, you have your outsourced marketer, I mean, there's companies that have like outsourced executives at the company helping do part-time. I mean, there's a lot of really important parts, and it's really cool what you get to do by making this change. So before we dive into it though, Zach, just give a quick overview of who you are, and then we'll dive into like how to think about this, prep for it, what happens afterwards, etc.
Absolutely, man. I'm so happy to be here. I appreciate you. So we specialize in corporate exit planning. Me and my partner, Mike at Reach Strategic Wealth, we have just put all our chips on this bet that all the dislocation that we're seeing right now and the, you can call it disruption, you can call it innovation, whatever you want to with AI, has this rippling up effect as we see the corporate landscape become more horizontal, which is our way of describing what you just said of things are just spreading out globally and strategically to where that ripple moves up to where specialists have this amazing opportunity in a way that has existed before, but we would suggest is probably amplified or even empowered now more than ever to be able to use those specialized skills independently if they choose to. And so for some of our clients, they're just pursuing their corporate exit, maybe towards a new phase of life, maybe towards early retirement. But increasingly, and one of the things that we love to see is I've spent these years earning my specialty in this corporate seat, and now I want to move that somewhere else. And you have the ability to do that. And it's super exciting. I mean, it really is phenomenal to see what people are able to do right now.
Yeah. I think advisors are kind of like an easy, natural side of this, right? Like a lot of us did that, right? You have the big firm, you have the brokerages, et cetera. And it's always been one of the easier ones to kind of go start on your own. Obviously, you have compliance and all these other barriers, but it's something that you easily can do. But I'm curious for you, people you work with, what do you see as the trigger most often for people ending up wanting to make this choice? And do you see most people that they like plan for this for a long time, or all of a sudden that trigger hits and they're like, we're doing it?
Yeah. Normally it's a combo of two. One is a real life event. And so we've kind of mapped these out for folks that very often it's a caregiving responsibility. For example, like either my parents are getting older or I have kids and I just want to shuffle the dynamic of my life for whatever way that looks. And it could be a financial break point where you say like, I think I can step back, but very, very often it is, I got my first consulting contract offer. Or my first one in my specialty. And it's really interesting to watch. I just got this offer, and it might not even be a really big one. Like I got offered 10 grand to help this buddy of mine who has a business do this thing or whatever. And then this light comes on that says, wow, if I could string together 7 or 8 of those, that would cover most of my actual basic living expenses. What would it take? And the moment you ask that question, man, you've uncorked the bottle.
I love that. That's the most common one I see. Is
totally.
it like it almost just falls in your lap? You're like, hey, my buddy's a business owner. He realizes that I'm in marketing at this company and they want help in this. Or I work in website design and they're like, hey, I need a new website. Can I hire you to do it? And they never really thought about it. They didn't market it. They weren't trying to leave. And they're like, oh, this is really cool.
Yeah, that's 100%. I mean, I have a case study that's coming out soon, but that is exactly that. It's like, I didn't mean to do this. I didn't even realize I was doing it. And on the flip side of that, you can see people who would say they have the golden handcuffs, but what they're really vocalizing is, I don't have that network that you did just describe. Like, I don't know how I would deploy my skills independently and how restraining that can be. And so, yeah, when that first contract lands in your lap, even if it's just a buddy, it really does turn the lights on for a lot of people.
I think that's a good point though, because I think a lot of technical people think that starting a business is about technical skills, but we can all attest to the fact that like technical skills are not the part that make businesses successful, because if you can't drive people in, you don't have a business to even deploy those technical skills. And so I think, that fear of, well, where is that first client coming from, or where is, well, that's only one client. You need more than one client. Where are those clients coming from is probably the right first problem to think about.
Yeah, I think that makes sense. And again, I think that's why that can become the ripcord point for people where, oh, that first client solved itself. And I maybe should think more about where's the second one coming from. But yeah, that's probably why that light bulb comes on. And it has this confluence of factors where I'm sitting in the corporate world in yet another meeting that doesn't apply to me, right? That's what people say all the time. Like, I didn't need to be in this meeting. It could have been an email. And AI and other tools have now made it to where, as a specialist, when I make this exit, I have a better chance than I used to have at being able to still just be a specialist, even though I do have to bring on the business owner hat. And that's, of course, where our conversations center around the money and the taxes and the cash flow around things. But when it comes to the supportive activities, the admin side of things, and even the marketing type sides of things, you now have infinite leverage on at your fingertips with the AI side of things. And so again, I think that's the ripple we're describing of real specialists, not necessarily everyone, but real specialists with real specialized skills are able to make this jump if they choose to, and if they do it thoughtfully.
Yeah. And I think there's like two routes now that you almost have to look at, right? I think there's like the financial planning side of, hey, what if I am prepping for this? Like, you got a couple years, you get to prep for it, like, is a very different financial planning strategy than for the people where you're like, today I'm going to do it because my parents, I have to take care of them, or because I need more help at home with my kids, or, I just hate it here and I can't do another day, right? Like, how do you think about financial planning for the people who are like, I know this is on my path, I'm working my way up at the company, I know I need to start my own company. What are the things that they need to do to best prepare?
Yeah, so we call that our stoplight plan. But if you've got that in your mind, so like let's set aside that I got laid off and I need to figure something out. Okay, that's one thing, and it's very reasonable and possible that happens. But setting up a stoplight plan while you're still employed is really possible. And there's an interesting phenomenon that happens. And by stoplight plan, I should say, red means you've not replaced any of your income or very little of your income, whether it's by consulting or maybe your portfolio plan or whatever's going to drive your income. You really can't leave. You shouldn't try to. If you do, you're going to be really scrambling. Yellow is where you've replaced a significant portion of your income such that probably you could pull the levers on your lifestyle and be okay at least. Like you were not really concerned about you paying the bills. And then of course green being like you're good if you want to go, and plenty of people are good if they want to. And then the decision is more philosophical. Do you really want to? What's in service of your family's goals? But what I found over the time doing that is for the people who are considering consulting as their next phase, when they hit yellow, if they hit yellow with momentum, so I've got some consulting contracts, they're coming in, I know where they're coming from, or I'm confident in my network or whatever it is, yellow is good enough for them, which is just super interesting to see. And obviously as advisors, it's not us saying, yes, you should, or whatever. This is us kind of helping them quantify and qualify what they want to achieve. But it's really interesting to have seen that a few times where it's like we've accounted for these things, and you've now kind of embraced your own vision of what's next.
How do you factor in cash to this? Because I think there's the side of like, okay, if a lot of these people are like corporate, some executives, et cetera, they probably have decent cash flow. They probably have RSUs. They probably have bonuses. But what if their portfolio isn't super liquid, right? They've been using their deferred comp plan. They've been using their 401k. Maybe they have some money in Roth IRAs. Taxable brokerage isn't really big. It's not supplying income. Do you think about this of like, okay, hey, in this next year we have 100,000 post-tax of RSUs. You have a surplus of 100,000. You can build 200. That's a year and a half of cash flow. So even if they don't have any income replaced, do you still think of that of like, okay, great, that's a year and a half. That means, within 6 months, if you add one client right now, you're sitting at 2 years or whatever. Like, how do you really think about the cash side of it?
Yeah, so we made a template that we just call our action plan to answer that question, but it's as simple as could possibly be a cash balance projection, where we take stock, like look at your balance sheet right now and you've got $50,000 in cash, accessible assets. And if we have somebody with higher level of assets, maybe in the taxable account, we can discuss how do you want that to represent. Is it need to be accounted for your long-term plan versus now, something like that. But to focus on the cash, let's say you've got $50,000 in cash right now. Let's just project this out. You've got this much coming in income. We've established, reviewed, and refined your expenses, both business and personal. And then if we go month by month, we do a rolling 12-month look. So if we're starting this month, we'll go through August of next year. Is there any point where your net cash flow in a month is negative? Probably is the answer for somebody who's consulting. Like your income's gonna be lumpy. So that's totally fine. We don't need that to be a huge red flag. But also highlighted on that template would be, is there any point where we're projecting your cash balance to go negative, which is not what you want. Either not what you want or not possible, depending on how you leverage yourself. But that is it literally, the cell changes a color on our template, and we're able to just be like, we need to just call attention here together. And we do this just with people, right? They're looking at it. And that's so powerful. And it's a really good exercise that I recommend. It's the same template I used when we moved last year. Like, let's just map this out to say, if we sell our old house here, we've got income, expenses here, buy a new house here. What are the incomes and the outlays happening to make things work? And does it look good? Does it cause us stress? Is there any problem here? Are we comfortable with how things are? And that also cues where we should drill deeper. Like, do we not actually know what you're expecting to make from your business? Because that's a problem we should address too. And you're a business owner, you get that. Like, sometimes we're optimists and we have high agency people. We're gonna figure it out. I always encourage, like, if you are an optimistic business owner, there's like a good chance your spouse isn't. So let's map it out so you can show them. That's a good idea too.
Yeah, I find that I think I work with maybe 75 to 80 business owner households now. Mm-hmm. And of those business owners, 95+% of them they're optimists in the way that they feel good about their business, think good about their business, but pessimists in the way that they think it's too good to be true, that something has to change in the near term.
Fall apart.
And exactly, because like for most people I work with, they're very, very successful right now, but it's like, oh, something has to change, something has to go down. And so that thought in their mind really kind of changes the way that they do financial planning, potentially not in a good way, right? It maybe makes you way more risk averse, way more cash heavy. And you need to kind of set up some rules to say, like, that's fine to start, but at what point do you realize after 6 good years of growing by 30% per year that you maybe don't need to keep $2 million in your business, or you don't need to be so cash heavy on the personal side. And I feel that way too, right? Like, it just always feels like, man, everything could come crashing down. I think for people who are going to start their business, it's really important to understand that that is so common, and there's good and bad to it. The good of it is you can use that to keep your foot on the gas, continue to work hard, continue to do good things. But you also need to make sure that you don't let it like affect you in your whole life, because it is normal. And I think that's why a lot of business owners actually, they're like therapists and business coaches and things, because that mental side of running a business that you've never had to think about as being an employee. And sure, as an employee, you have to think about layoffs and you have to think about different things, but you don't really have to think about like 2 months from now, like, what if I lose 50% of my revenue because one of my 2 clients is gone?
Yeah, I think that's exactly right. I was gonna ask you if you'd experienced the same cash grab phenomenon. Like, I just want to hold it. And I think that probably is exactly stemming from being a high agency person, meaning like you've got that I'm going to figure it out gene ingrained in you or whatever, where that gives you the tools to figure stuff out, right? You say, I've got $100,000 in the bank that's not earmarked for anything. I can figure out I could rebuild my business if I had $100,000 kind of idea. And
totally.
And that's actually really reasonable and logical. And it comes from a very, very real place as a business owner that we need to be able to account for and adapt to in their planning process.
the more that I've run a business, the more that I realize I could figure out a lot of different businesses. Like, I just see in the service world area. And after doing this, I'm like, I could start a really good tax firm. I could start a really good, event planning. I could start there's just like so many other areas that I feel like it's so scary to go start a business. And then when you go to start a business, you realize there's like 3 things you really need to nail down that people focus on all the other stuff. You really need to nail down how you're going to drive people in. I feel like I understand marketing. I understand how to do that. You need to figure out like, what do the people you're trying to work with, what do they really most want help on? Because a lot of times as business owners, you think about a million things instead of like, what are the core things that bring 90% of the value of what you're doing? And then how do you hire a team to help you do those and be the most efficient? Like, I feel like when people go start their business, what they want to think about is, how do I save on taxes? Do I need to be an S corp or do I not? Like, what website do I need it to look like? There's all these things to think about, but really, if you don't nail those 3 core things, like all of those things really don't matter.
I think I say the same thing you just said, but I say it in the opposite, where I say you're probably bad at most things. Right. And I mean, not you, but like we are probably bad at most things that highlights, though, especially if we're talking about this corporate transition, if you're a specialist, the highest leverage thing you can do is be a specialist. And
100%.
And as a business owner, you're not afforded the luxury to only do one thing or to only be a practitioner. But again, now you're able to get closer than ever to where you just identified your 3 highest leverage things that probably are the highest leverage things for whoever is the executive at any company, the person in charge. And the truth is, like, you're probably bad at a lot of other stuff. And so now we know we need to delegate and we need to hire, we need to outsource or eliminate those other activities, which is just super interesting. As I see people make this transition and they're able to really lean in, they have no more corporate meetings. They have no more email chains they're not supposed to be a part of for the most part. They're able to say, this is my thing. I really have to get this off my plate. And how phenomenally empowering that is. It's such an awesome thing to watch happen.
And I think this is one of the biggest lessons business owners need to learn, is that like, you really aren't going to be good at everything, but you do need to figure out like, what are the things that you're the best at and that you also enjoy doing the most, right? So like when I thought about hiring, I was like, what are these areas where I know I'm not excellent at, but also are really draining? And so to me, that's a lot of the organization, background operations. That's going to be like reading through really long documents. It's going to be making spreadsheets. Like, I really love the growing the business, making the big decisions on a financial plan, explaining them to clients and helping them get things done. Like, everything else I want to offload. And I think for a lot of people, like even hiring a financial advisor, for example, a lot of people, especially employees, see it as a cost, right? They're like, hey, I have this cost of doing it. But as a business owner, you need to think of things about like, how do they lead to the most efficiency, the highest revenue, the highest profit? And I get there's the part of like, there's some advisors who choose to not scale, right? I'm going to work with 40 families. I'm going to enjoy it. Maybe I won't hire things out. But for the vast majority of business owners, they are going to be like trying to increase revenue, try to increase profitability, and try to make it as good of a role as they want. And so hiring out those areas starts to make sense, because if you're like, hey, I could spend, for example, people hire outsource CFOs, right? If they're like, I know nothing about balance sheets, I know nothing about cash flow, I know nothing about P&Ls, I know nothing about how to actually manage and operate this, they can either spend tons and tons and tons of hours trying to go learn that on their own, which they're smart, I'm sure they could, or they could basically pay somebody for way less than it's going to cost them by how much time it's going to take, so they can stay in that area of excellence. And for the people we're talking about here, the reason why they're able to start a business and be successful in this, especially this service consulting business, is because they have an area of excellence. Like, do everything you can to spend every minute you can working in that area, because you can make a very high hourly rate doing that. Some people it's 250, 500, even above that hourly rate. Those other things you're thinking about hiring out are probably like a tenth to 25% of the cost it's going to take to give up your time in those areas.
Yeah, I try to prompt that conversation early on if somebody's truly launching a consulting side business, where we talk about their bookkeeping. And it's really easy, because that is traditionally priced as an hourly service, and maybe you actually pay monthly, whatever, it doesn't really matter. But $75 an hour ish to $125 an hour for a bookkeeper even at a traditional, at your accountant's firm or whatever it is. And you're really readily able to say, hey, what is your quote unquote hourly rate for being on site at a, what is it? $500 an hour, $400 an hour, $8,000 an hour. I don't care. It's more than the bookkeeper. And that just is a good framework to say, well, then let's look at the reasons to delegate that, because you're also, as the person driving this vision, you're also probably bad at that. Like, that's probably not the thing you're waking up and checking on your transaction report from the day before. That's a good way to just tee that up and apply that logic across the board until, yes, it's something you're actually, I want to learn this. I want to understand. I want to grow, whatever it is.
Yeah. I mean, it makes so much sense. And I think it just takes people a little time for that to click, because it's just not been the way that they view their life. Like, everything was viewed on like the dollar, what I have, and how do I become the most efficient with that dollar, to not like, this is the same thing in a different way. You're being efficient with those dollars to be able to generate more by freeing up your time and allowing you to stay in that area that you're really good at.
Totally.
Okay, so let's just think through. So you're prepping to start this business, right? I think there's this side of, right, the I want to be an entrepreneur. I know I'm going to do it. And for them, it's really easy, right? It's stack cash. You know, my recommendation, I'm curious to hear yours, is like 2 years of expenses. Like, if you can get 2 years of expenses built up, very few people are going to fail when you give yourself that runway. What we find is that the people who fail as business owners come in with unreal expectations. They think, hey, day one, I'll be able to get to 50% of my expenses. By 6 months in, I'll have all of them. And so they come in with such a low cash figure that they basically run themselves out of the business. So I think like that's step one. Hey, focus on liquidity, focus in on cash. You know, I'm curious on your end, how do you think about your portfolio? Because I think there's part of it to say, do you kind of scale back risk in a certain way? And you know, maybe if you have cash, you don't. In my mind, if you have the cash, you don't really need to preemptively move to be way more in fixed income or way more in bonds. But how do you think about it?
Yeah, we like to describe that the area of our portfolios where we want to be active is on the cash management side, and that would include your fixed income bucket. And by active, we don't mean in security selection. We mean in how it relates to your personal goals and plan. And so using that sort of asset liability matching approach to be able to really articulate, you've said these are your goals and these are your timelines for your goals. Are we accurate about that? Do we understand that? If somebody's not able to articulate that, well, then we've got work to do on that front of things to develop that picture. Naturally, accounting for unknowns is really hard if it's how fast is your business going to grow. But it being hard is not an excuse to not do it. And so us being able to take that sort of action plan approach and say, we have, in fact, mapped out what your revenue targets for your business should be. And we found a lot of times with the specialized consultant type folks, setting revenue targets is a new thought process because it's not generally required. You've been successful in corporate. You're a high income person, most likely. Even replacing a small percentage of your income is probably a meaningful dollar amount. And so the thought process of like, well, if I just add one more, I'm probably pretty good, is a very logical one. But when we're talking about the integrity of your long-term plan and how you like use your portfolio from there, it actually does matter, right? To say we've replaced this much, or we've satisfied the total need of for your income, so your portfolio is fine to just not be touched. So that's where we approach that. Is if you have cash needs from your portfolio, certainly we want to move that up and have that secured in that 0 to 5 year range. And that could look like any number of appropriate things to satisfy that. But beyond that, yeah, we would very likely stay very equity heavy, as is our philosophy across the board, really, to take that approach, and then maybe a little longer as you really approach full retirement.
That makes sense. How do you think about like good financial planning moves to make during like in this time? So you've been a high income earner, maybe you've built up a lot of wealth, maybe again, deferred comp, you've been using, you know, all pre-tax accounts. This is a really good opportunity for Roth conversions, you know, even funneling taxable dollars into a solo 401k and doing Roth contributions and moving from taxable to tax-free. How do you think about those moves?
Yeah, I mean, we can talk any one specific that you want to. I draw this chart for people that highlights what I call your strategic planning windows, where we start from your corporate world where things are like, I'll describe as fairly static. And I'm not talking about like, sure, you have equity vests or whatever, and that brings its own, that's one window that we describe. But then when you leave, you've got this very likely lower income year That's a new window. How do we want to deploy that? And then it's altogether likely that your income rises to a new peak, or to a local peak at least. So that's another planning window. What do you want to do in these high and low income years? And then maybe it's scaling back as you near retirement, of course. And so, yeah, much to your point, I think that's really, how do you view what I should do in a low income year versus what I should take advantage of in my highest income years? And then the decisions flow pretty naturally from there to how do you optimize those things? We can talk examples if you want to.
In my mind, I think of, okay, so like you're finishing up this year, high income earning year. If you're charitably inclined, let's do some charity in this year, right? Because potentially the next few years, you might not have a lot of income. It might be in low brackets. So, hey, we're in a high income bracket. Do we have some old basis stock that we've been thinking about diversifying from? Can we maybe take care of the next 5 years of charitable giving so we can actually use those high brackets? And then we get into that next year and we think, okay, I would probably start Roth contributions, just because we don't have the added tax of the conversion. So, hey, starting this business, do we have any income? If we have any income, can we get in Roth contributions either through a solo 401k or through, your Roth IRA? Okay. If we don't have a lot of earned income, or there's just, not a whole lot to do there, then we start thinking about Roth conversions. But again, you have quite a bit of room in 0, 10, 12, 22, 24, where you can do quite a bit of Roth conversions without needing a whole lot of cash. But that's something, right, you would plan with, something I would plan with my clients, of saying, hey, let's hold extra cash versus putting in a taxable account versus doing something else, because we plan next year to do Roth conversions. And this is going to be extremely impactful for you, because now we get to move to Roth, we fill up low brackets, we have a lot of time to grow from there. The other, you go. Do you have something you want to add?
Oh, no, you're good. Go for it.
I was just going to say, the other thing that I would want to start to think about in this year, which is probably pushed, is like, what about tax planning for the business in general? Because I think a lot of people assume I'm starting my business, I need to nail down my entity election, all that stuff. I typically feel like that first year is really not a very good time to do that. Like, you're probably starting out as an LLC, maybe we're thinking partnership or S Corp, but we probably don't want to be a sole prop if you're going to be in any tax or any high state tax place, because you have no PTET ability. You can't pay the state taxes through the business. But you also don't really want to rush into an S Corp, because when you're at a really low profit, typically like 100, 150, et cetera, you're not coming out very far ahead, right? You have some self-employment tax savings, but you might have PTET, but you're giving up QBID, you're reducing retirement contributions. So at that point, it's typically not quite worth it yet.
Yeah, well, first of all, absolutely. People like to jump the gun on that. And I think the better summary, I don't mean better, an appropriate summary of that is just keep your eye on the ball. Because I've had a number of conversations of agony over what kind of entity I should be. Like, well, you should go get a client. That's what you should do.
Yes.
That's going to solve all your problems. And the same goes for a number of things. But to just retrace, I can give some recent examples where someone was approaching their exit date, and they're just enormously, they've recently entered a new role, and they're by far their highest household income level. Well, it's just a great opportunity to do anything we can to save marginal tax in these years. Like, it's just that's a dialed in focus, right? And that could look like charity, and that could look like what savings vehicles they use and things like that. But it's going to fall off a cliff. I mean, an absolute cliff the moment they make their exit. And so that's going to queue up this next phase of opportunities. And for some folks in that realm, we've done, of course, donor advised funds to really front load their charitable giving, and then really utilizing these low income years for potentially, yes, moving funds to Roth, but also a good opportunity to lower or reduce concentrated stock risk in your plan. And so for
tax
executives
gain harvest,
for executives who are sitting on these concentrated positions, are we able to use this low income year really advantageously? And yes, it might be a combo of things. Like, we recently had somebody who had business income but was low on liquidity, and we were able to sell some concentrated positions to fund to kind of wash over to retirement contributions from the business to help satisfy some liquidity needs and things like that. Like, that's just a broad strokes type of example. But that's by understanding that you're in a strategic planning window, and what is open and what is closed kind of things. And along the way, there's, of course, really good just basic planning for how you're going to operate your business and take advantage of tax moves that you can do. But those windows are only open for so long, right? And it's okay if you miss one, but they can get missed, and that's where being timely and proactive on things really matters.
But I think the hard part here is a lot of people are scared of having costs during this down income year. But the issue is, by being scared of those costs, you end up missing out some can be pretty life-changing moves, right? Like you could potentially get a couple $100,000 of pre-tax assets moved over at a very, very low effective rate. You could potentially, let's say, hey, I'm finishing my business I'm finishing my W-2 right now. I'm starting my business in this last quarter. And then all of a sudden you start next year and you're like, hey, we're killing this. Like I can retroactively use a solo 401k and get a bunch of money on a pre-tax basis because Q1, I can almost funnel money back in that way. We can talk about contributions. We can talk about making sure you donate and do the donor advised fund. We can talk about, did you get the right entity election right? There's people who, for a bunch of years, maybe partnership with your spouse ends up being the best thing. We get double solo 401ks, or, I have a bunch of clients who came in that they've missed 3 years of PTET elections and paying state tax through the business because they had no idea about it. They've just been filing as, a sole prop, not really thinking about it. So there's these windows where you can make really impactful moves, but you're worried about the costs. And so obviously when you're evaluating getting help, you need to think, what are the costs, but what are the benefits of being able to do these? Because for some of these really high earners who go to the business, they might never have that window again. But that window might come with 20 to 30 years before retirement, where now you move and open up a ton of great tax-free compounding, for example.
Yeah, and this philosophy is true for people who are going to start their own business. It's also true for people who are going to take a sabbatical or retire early naturally, or just have a window of time. Maybe it's a maternity or paternity leave and a job switch. Whatever these things are, the window just opened. And are we able to be present and proactive enough to take advantage of those things? Whether you're working on your own or you're having a team, you want them to be heads up and ready and able to be responsive to those windows, because again, they just are only open for so long. And it can feel really overwhelming to the list of vocab that you just used, that like, if I've got to get up to speed on that, like, oh my gosh, it's like too much, and you get paralysis. But the thing I always like to describe is the number one tax hack you can possibly have is to look. I mean, the number of things that you'll find, I'm sure you've experienced it, and that we'll find in any given year by just literally requesting someone's return and reviewing it. And yes, that requires some actual knowledge and insight. But if you as an individual even go through your tax return just with a kind of moderately aware look and say, like, what is that? That doesn't, or why is that line blank? I mean, you probably have people every year who their health insurance, their self-employed health insurance deduction doesn't hit right or isn't recorded or whatever every year. And so the number one hack is to literally look. And the same goes for your portfolio statements, and the same goes for your expenses. If you can muster up the courage to just open the folder, open the file, and you'll probably cover a lot of ground that way.
It's funny. My thread today was about how to read your own tax return, because I found that, like, most people don't. They don't know anything on it. They don't understand it. But, like, if you're not looking into these things, you're leaving on the table. Like, just in this last 2 weeks, I had one client who they didn't have QBID on their return. I've never seen it, but they had a business, no QBID. They deserved QBID, $8,000. They got back when we let their tax person know. Yeah. Another person, I was looking at their pay stub, and it was basically counting their RSUs there. But then if you go to their cost basis on their company stock, it's $0 cost basis. So then it was pulling to their tax return this added tax, when in reality, they're going to have significantly less tax. Now, if you don't understand RSUs, you understand cost basis, you understand where they're going to be taxed, you don't really understand it. Health insurance is a common one you see. Taxable for backdoor Roth is one that you'll see very often. There's just things that get missed. And I think what people all the time, they'll blame their CPA or their EA, when in reality, you didn't tell them what happened. And so they're just taking these documents and they're filing them. And yes, you want them to get everything right, but if they don't know the story, in the same way with your bookkeeping, right? Like, your bookkeeper could totally report something wrong, right? Like, I have clients who they have a sole prop and they're going to go pay their taxes directly from their business account, but all of a sudden it comes as a deduction. And that's wrong. And there's just so many things that if you don't communicate, don't tell the story, don't look and ensure it got recorded correctly, it didn't.
It's constant, and that's where there's this gap between traditional investment managers, portfolio manager types that we would broadly call financial advisors, but wouldn't necessarily doing business the same way you and I are, and traditional tax preparers who are prep focused. Both of those roles make sense, are not clearly defined. Like, I'm preparing your return, but that leaves a gap. And that's where this thing of just looking, where some way and somehow you're informed by the story and the knowledge. Like, you understand what the tax return says, and I know the story behind it. This is where because you're aware that you had RSUs last year, you know that that's part of the story. You know that this form is coming out, and you know to check the basis, because that will happen every year. I don't expect it's going to stop happening. It's going to continue to happen because of custodian nonsense. And you know that this person operated a business. You know that you should check their QBI deduction, because it might not even be calculated correctly. It's such a weird thing, especially if they prepared themselves. And you're like, oh my gosh, it's actually blank. That's not right. But it's because you have the story and you have the knowledge, and you're able to leverage that in a timely way to actually provide value. And that's what we're talking about. If you want to do it yourself, but you need both those things. Or if you want your tax preparer to be able to do it, you have to provide them the story and probably pay them more to do it. And so that is so important. And I think it's the number one thing that causes frustration for people, as well as miss wealth building opportunities.
Yeah, they're like, hey, how come my advisor didn't see this or say this? And in reality, it's because you're not working with an advisor who specializes in that. It's why you specialize. It's why I specialize. And that's why, for a lot of my clients, they come from, the Goldmans or the JP Morgans, or they come from their parents' advisor who might be excellent at what they do. And they're like, sure, we'll take on your child. But in reality, they have no experience. They've never run a business. They don't know anything about a business. They don't know anything about your equity comp. Like, that's not the area that they're meant to spend time in. And at the end of the day, you want to work with a specialist. You want to work with people who already know the issues that might exist before you've even noticed them. Not somebody that you have to say, hey, I think I have this issue, because you just aren't going to know to look for them. You're going to file your tax return, and you never would have known QBID. You never would have known the cost basis was zero. You just thought that the custodian had it right. Those are the taxes, and everything's done correctly. And that's just not really how it goes.
You just mentioned a thread. I'll throw one out that I did last week, maybe 2 weeks ago, where it was how to find a high value financial advisor with no fee nonsense, because I'm over it. That it was to say, articulate for yourself, what specialty do you need? Like, are you in the retirement phase? Do you need somebody who's like, I'm a legit expert in retirement income? Do you need somebody who does whatever? And for you, it's small business owners. For us, it's exit planning. Somebody articulate what you need. Find somebody who says that they do that. And that's step 2. Like, okay, great. Thomas says he works with business owners. Okay. 3, prove it. Like, show me literally the systems and the specialized services that you have that mean you can actually do this. And almost no one does that. They're like, I get a referral from a friend, and they go to Goldman or whatever. And that's it. And it's end of story. And then they're not speaking to whatever specialty it is. And there's a whole list of things that I'm not the person for, and you're not the person for. And then when you come to us as a person who needs a specialty, we want to be able to provide the absolute best service possible, and the best insights possible for someone exactly like you. And if more people did that, they would have a way easier time finding an advisor, most likely, but they would also end up with higher value relationships, in my opinion.
Yeah, focus on the specialty, the person you need, somebody who can help what you're going through. Don't focus on a firm name. Don't focus on anything other than who can help me on what I need help on. I think that's a perfect way to end. So, Zach, appreciate you coming on, man. Everybody, thank you for listening. We're going to do another episode with Zach that's going to be a little bit less financial planning related, more life planning related. So make sure you tune back in for that episode. We'll see you next week, guys.